Hey there, it's Dave Keller here with Stockcharts.com, and welcome to this special edition of The Final Bar. We're on vacation this week. I've got my family in Ireland, so we recorded 5 episodes to share with you through the course of this week. We're calling the group of 5 of these top 10 charts to watch for August 2024. On Monday's episode, we talk about the Magnificent 7 stocks, the mega cap growth names, 2 that I think are super important. Yesterday on Tuesday's episode, we talk about a defensive sector, consumer staples, and some of the charts like Clorox are actually improving. And don't forget to go back and watch those. If you missed them, you really can go through all 5 of these, get some individual ideas. And I think the benefits of this series are twofold. Number one, give you ideas, actionable charts that we feel are important to watch here in the month of August. And then number 2, to highlight how we can use the Stockcharts platform to anticipate moves, to identify those candidates, to monitor levels and scan and set alerts and ways to empower the Stockcharts platform to help us make better decisions and stay on top of these markets. Today, we're going to go defensive even further. We're going to talk about even deeper defense. If you thought consumer staples are defensive, how about utilities and real estate? Utes and REITs, these are the 2 most defensive sectors, I would argue. What the key with something like utilities or real estate, particularly money managers, you don't own those sectors unless you don't want to own something else. And that might be a little counterintuitive. As an individual investor, you have a lot of flexibility because if you don't like any stocks, you can actually just go all to cash or go to bonds or something else, right? You have the unlimited flexibility in a lot of ways with ETFs and options and everything. We have so many things that you could do if you're concerned about the market going down. But a professional money manager running an S&P 500 benchmarked fund, if you think the market's going to go down and if you're concerned about downside protection, you may not have many levers to pull because you still have to be fully invested. You still have to have most of your portfolio, if not all of it, in stocks. And so you have to go somewhere. So what you do is you go defensive, right? You go to defensive sectors like utilities and real estate. You do that for 2 reasons. Number one, because they're lower volatility, right? So if you think about the market going higher, when the market goes higher, that's why it's good to own higher beta or higher risk names, smaller names, growthy names, because when the market's going up, they tend to do even better. They go up even more. But those same stocks, when the market corrects, those stocks tend to go down even more than the market as well. So if you're concerned about the market going down, you go to low volatility names that don't move a lot in terms of their price, because if you can go down a little bit when the markets are going down a lot, then you're probably going to be able to outperform pretty easily during a down market trend. It's a common technique used by money managers. The second reason, besides low volatility, is the income component, right? A lot of growth stocks don't pay much of a dividend. Utilities and REITs pay a really good dividend, relatively speaking. And so going into those areas of the market where you have an income component can help to cushion the downside when the benchmarks are going lower. So when you see an improvement in defensive sectors, that usually tells you something interesting is going on. As we're looking at the chart here of the relative performance of defensive sectors, when I think about the markets here in August of 2024, I think one of the biggest changes we've observed from early July to mid-August has been a dramatic reversal in the relative performance of defensive sectors like utilities, consumer staples, and real estate. And those are the 3 from top to bottom. These are the relative performance lines showing you the relative performance of that sector ETF versus the S&P 500. When these lines are going up, that means they're outperforming the S&P, and you can see all 3 of these have generally been trending higher in the last 4 to 6 weeks. Now, to be honest with you, the way that I found these, or I guess another way that I thought about that particular rotation was using the RRG, and that's the tool I want to highlight today. The relative rotation graph is so helpful at recognizing the movements in sectors, the relative movements in sectors. And one of the big changes that I've observed here, and I'm taking the weekly RRG and I'm backing it up to like the April low. Look at utilities right here in blue, and you can see as we fast forward into May, into June, into July, you can see how utilities have kind of remained farthest to the right. And here just recently, going into mid-August, utilities have actually made a cyclical move to the right of the y-axis. Real estate, the other sector we're going to talk about today, heading firmly northeast. So 2 of the most defensive sectors are actually showing the most constructive rotations, meaning they are starting to really improve in their relative momentum to the other 11 or the other 9 S&P 500 sectors. So we've had a rotation to defensive. How do you play that? Well, you can always play it with ETFs like the XLRE or IYR or XLU for utilities, or we can look at individual names. And let's look at two of those that I found in some scans that I think tell the story of these defensive areas pretty well. This is a stock called Extra Space Storage. Real estate, what we think of this as sort of one sector, and it is, but it's actually somewhat diverse at times, right? A lot of these own, mortgages, own, single family homes, residential office REITs, hospitals, malls, all sorts of retail spaces. And then Extra Space Storage is in there with a couple other names that are, storage names, right? Sort of those, big, store your stuff kind of places you'll see off a highway wherever you're at if you're in the United States. So EXR overall has not been a particularly strong name until Q3, right? Q1 was about a pullback after a nice rally into year end. Q2 was basically sideways and choppy, right? And so EXR is sideways between 130 and 150. What I love about this chart is right here in June, right? We had clear resistance around 150. We gapped higher in mid-June. We pulled back to the breakout level, and then we resumed the uptrend. We've now made a pattern of higher highs and higher lows above two upward sloping moving averages. And when I think about what defines a chart in an accumulation phase, which is generally speaking when long-term investors are accumulating positions, is you have higher highs and higher lows. Those higher lows inspire long-term investors to layer into their positions and accumulate more. That provides the next swing higher that makes a new all-time high. Eventually, we pull back a bit. You see additional buyers come in. This is the buy on the dips kind of pattern. So when you have stocks making higher highs and higher lows above two upward sloping moving averages, that's a sign, or basically the markers of a chart in an accumulation phase. You can also see that the RSI has generally been above 40, and that goes back to really sort of the first quarter into April. When you finally start to break out of this range in June, you can see that we've generally remained above 50 that entire time. So when the RSI is pretty much always above 50, that tells you that even the pullbacks are not too weak. There's enough buying power to continue to push that trend upward and upward. So what's interesting about EXR is the fact that it keeps making higher lows. I think that makes it very easy if you get into a position, because these charts feature what's called a natural stop. And a natural stop for me is you look on the chart and you have a clear recent pullback level. And I have no problem saying I'm long here and here's my stop. You've clearly defined your downside. You're basically betting on the trend persisting. You have an exit to limit your downside if the trend does not persist. I don't think that's a bad idea in a defensive area of the market right about here. The other thing that's key with defensive stocks like REITs is that they pay a decent dividend. So this one, a decent dividend, I meant to say. This one pays a forward dividend yield around 3.9%. When we say forward dividend and forward yield, basically using our data providers to project what the next 12 months of dividends are going to be. It's not a guarantee, because companies can change their dividend at any point. They can do special dividends. This is an estimate of the next 12 months and what you could expect, assuming the price is stable and the next 12 months of dividends pay out as anticipated based on a historical trajectory. That gives you a forward yield. So 3.9% is pretty good when you think about the 10-year Treasury yield, getting further away from 5% and down into the 4s and now down into the 3s. 3.9% yield on your stock seems a little more attractive. So EXR, compelling rotation higher. I like the breakout. It's in the accumulation phase with a decent dividend. That's why REITs, generally speaking, and this is one example in the REIT space. There are many others. I'm giving you an example utility as well. There are many other utilities that have very similar structures. So I'd encourage you to do a little more deep due diligence if you're looking to add exposure to this space. But Southern Company, SO, this is sort of a conventional utility. There are others that have specific mandates and specific businesses. This is sort of called a conventional electricity name. At least that's what the group is called. Similar in a lot of ways to EXR, although the rotation has been a little broader, right? If you look at the first quarter of 2024, we're sort of continuing this consolidation phase, this sideways trend that Southern had been in. But then finally in April, we break out. And this is an example of a chart that I would call a big base breakout. And I refer to this in one of the earlier episodes this week. A big base breakout is where you have a big sideways pattern, the kind of pattern you could draw a rectangle around and it'll capture most of the price data. That's what we call a base. When you break out of that base to the upside, we call that a big base breakout. And one of my Fidelity predecessors, a guy named Bill Doan, who ran the team in the 1970s and 80s, made a name for himself by identifying big base breakouts. He would argue that in any environment, you probably can find them. And this is the type of chart. And may he rest in peace. This is the kind of chart I think Bill Doan would still get excited about. Big base breakout has a consistent resistance level, in this case around 72. You finally break out above there in mid-April, and then you don't really look back. From there, we've made some higher lows, which means, similar to a pullback to the 50-day moving average in July, you could pull back a little bit, in this case, all the way down to around 81, 82, and still be above an ascending 50-day moving average with, for now, very positive momentum. So I think charts like that, breaking out of an established base, again, with a decent dividend yield over 3%, interesting place to be. With both of those charts, with Southern and with Extra Space, EXR, they're low volatility, meaning they tend to move a lot less than the major averages, which means if you're concerned about downside, if you're concerned about the seasonal weakness, which has been pretty consistent here in recent, in the modern financial era, with weakness August into September and major low often in September and October. Charts like this with a decent dividend and showing the strength that they are great ways that money managers have found in previous bear market phases to outperform. You own things that are defensive, that are not going to go down as much, that have a decent income component. That's a way you sort of weather a period of market uncertainty. So if you're nervous about the market, I'd be looking defensive at some of the utilities and REITs. I found those two names by using our scanning engine and looking at some of the results there. And the RRG was so helpful at helping me identify these particular themes to pay attention to. That's it for our third episode. Make sure you tune in on Thursday and Friday. We'll continue this series of top 10 charts to watch for August 2024. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well. Have a good night. We'll see you soon.